Let's discuss on financial instrument. That's under IFRS 9. Financial instrument. Will I see that? Financial instrument, financial instrument, financial instrument is a financial contract, is a financial contract, is a financial contract, is a financial contract, which gives rise to an asset to one party, which gives rise to an asset to one party, which gives rise to an asset to one party, and a liability to the other party, and a liability to the other party. You think that is a financial contract which gives rise to an asset to one party and a liability to another party. E.g., loan, debentures, shares, cash at bank, debtors, etc. Yeah, that's what we call a financial instrument. You think that is a contract that gives rise to an asset to one party, then becomes a liability to another party. Now, for example, if you sell goods on credit to another party, that means you become a debtor, right? You become a debtor. To me, it's a what? For me, I'm expecting to receive. So to me, it's an asset, right? But to you, becomes a what? A liability because you expect to pay. If you take a loan from the bank, so to you, a loan becomes a what? A liability. What about the bank? An asset. If you deposit cash to the bank, you take 100,000. To you, becomes a what? That's your asset, right? What about the bank? A liability, yeah, because it's the customer deposit. Now, that's what we call a financial instrument. Now, let's look at some terminologies. Number one, financial asset. Number one is the financial asset. You have to say that. This is any asset that is, this is any asset that is, this is any asset that is, semicolon, A, cash, B, contractual rights to receive cash, contractual right to receive cash, or any other form of asset, or any other form of asset. Number three, or C, an equity instrument of another entity, an equity instrument of another entity. Number two, financial liability. Number two is the financial liability. You see that? This is a contractual obligation. This is a contractual obligation in which an entity, expects future outflows, in which an entity expects future outflows. Yeah, actually, that's the distinguishing characteristic or definition of an asset and liability. An asset, whenever someone asks you what's an asset, just mention something you expect to receive the benefits in the future. A liability, you expect an outflow in the future. That's the difference between an asset. An asset, you expect some future cash flows. Liability, you expect future outflow. Number three, equity instrument. Equity instrument, where do you see that? Is any contract, it's any contract that is evident, that is evident, that is evident, that is evident of a residual interest, that is evidence of a residual interest in the asset of an entity, that is evident of a residual interest in the assets of an entity after deducting all the liabilities, after deducting all the liabilities, after deducting all the liabilities, after deducting all the liabilities. Good. Now let's look at types of financial instruments. Types of financial instruments. Types of financial instruments. Number one, we have financial asset. Number two, we have financial liability. Number three, we have equity instrument. And number four, we have derivatives. We have derivatives. Yeah, those are the four classifications of financial instrument: a financial asset, a financial liability, an equity instrument, or a derivative. Yeah, derivative, they are those, they include what we call the swaps, discuss them in financial management, future option, the forward contracts, the option, all that. Good. Now let's look at what we call the classification or types of financial assets. Classifications of types of financial assets. Good. Now let me explain. Now we have fully integrated to IFRS 9 is the most recent adjusted standard. Before we had what we call IAS 39, of which under IAS 39, the financial assets were classified into four. Number one, we had the financial asset at fair value. We also had available for sale financial asset. Available for sale financial asset. Then we had held to maturity. And then number four, we had loan and receivables. Those were the classification of financial asset as per IAS 39. But now we are no longer using IAS 39. It has been fully integrated to IFRS 9. When the IFRS 9, all the financial assets are now classified into three, where we have number one, financial asset at fair value through P&L, profit and loss account. Number two, we have financial asset at fair value through the OCI, through other comprehensive income. And then number three, we have financial asset at amortized cost. Those are the three classifications as per IFRS 9. Now, financial asset at fair value, these are, don't write, these are short-term financial assets, such as the treasury bills. Yeah, that's the financial asset at fair value. And that's why we say that they are financial asset at fair value through P&L. Why is it through P&L? Yeah, that means in case there is any fair value changes, you recognize them to other incomes. That's why we take it to the P&L account. Then we have financial asset at fair value through other comprehensive income. Now that's our available for sale. And these are long-term financial instruments, such as bond, convertible debentures, rolling note, all that, yeah, which are held for long term to earn, number one, the contractual annuities, that's the interest, and then you expect it to hold it to maturity. Also, the equity instrument, the shares, also fall under this category, because if you buy share, you expect to receive the dividends as well as the capital gain. Then lastly, we have financial asset at amortized cost. Now, financial asset at amortized cost only deals with the debt instrument and not all the debt, or the debt instrument. I mean this with some debt instrument, such as a debenture, a bond, also rolling note. But in case the debenture is a convertible debenture, that's what we call a compounding financial instrument. Yeah, what's a compounding financial instrument? Now, a compounding financial instrument is a financial instrument which has both the debt element as well as there is equity element. Yeah, if you have a convertible debenture, that means at one point of time you can convert it into ordinary share. So that gives it right to the equity element. And then before the maturity, it gives that the debt element. Now, in case it's convertible, it does not qualify to be at amortized cost. So we come to discuss some of the tests for that financial asset that have to qualify for it to be recognized at amortized cost. Yeah, those are the three classifications of financial assets. Financial asset at fair value through other income or through P&L account. Financial asset at fair value through the OCI, that's the other comprehensive income. And then we have the financial asset at amortized cost. Another thing, how do we measure this financial instrument? That's the measurement. Measurement. We have the initial measurement, initial recognition, and measurement. And then we have the subsequent. Subsequent measurement. Now, initially, all the financial instruments, not just the financial assets, all these financial instruments are initially recognized at fair value. At fair value, with the changes taken to either other income, that's of the P&L, or other comprehensive income. I repeat again that all the financial instruments are initially recognized at fair value with the changes taken to other incomes. That one only applies to this for the short-term asset, or through OCI, other comprehensive income. Now, for other comprehensive income, that will comprise the long-term assets. That's the financial asset at fair value through OCI, or financial asset at amortized cost. Then subsequently, after initial recognition, how do we recognize them? Also, subsequently, you can also measure them at fair value through either other income or the P&L or OCI, or you measure them at amortized cost. Yeah, subsequently, it's either you measure them at fair value through P&L or through other comprehensive income, or you measure them at amortized cost. What do you mean by the amortized cost? Amortized cost, that means you discount the expected future cash flow. This is the present value of the future expected cash flow. Yeah, it's equivalent to the value in use. Good. So we are looking at classification of the type of financial asset. Let me see that. IFRS 9 classifies financial assets into three as follows. Classifies financial assets into three as follows. Number one, financial asset at fair value. Financial asset at fair value through profit and loss account. Financial asset at fair value through profit and loss account. Then you explain, see that? This includes any financial asset. This includes any financial asset. This includes any financial asset held for trading purposes. Held for trading purposes. Held for trading purposes. And also derivatives. And also derivatives. And also derivatives. And also derivatives, i.e., short-term financial assets. The short-term financial asset, such as treasury bills, such as treasury bills, such as treasury bills. Full stop. These financial assets, these financial assets, these financial assets are initially recognized, are initially recognized at fair value, are initially recognized at fair value, are initially recognized at fair value. Full stop. Subsequently, they are remeasured, subsequently, they are remeasured and recognized, they are remeasured and recognized at fair value, at fair value, at fair value, with the changes taken to profit and loss account, with the changes taken, with the changes taken, with the changes taken to profit and loss account. Good. So you see that for financial assets through P&L, initially you measure them at fair value, and then subsequently you measure them also at fair value with changes taken to other incomes. Number two, financial asset at fair value through other comprehensive incomes. Financial assets at fair value, financial asset at fair value through other comprehensive incomes, through other comprehensive incomes. In bracket, available for sale, available for sale, AFS, available for sale. What is that? These are long-term financial assets. 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 First of all, it's typically applicable. It's typically applicable. It's typically applicable. It's typically applicable for the equity instrument. Is typically applicable for equity instrument and debt instrument and debt instrument and debt instrument that an entity expect to retain, that an entity expect, that an entity expect to retain, that an entity expect to retain ownership, that an entity expects to retain ownership on a continuous basis, on a continuous basis, on a continuous basis, on a continuous basis. Full stop. Another paragraph. Initially, these financial assets are measured. Initially, these financial assets, these financial assets are measured at fair value, are measured at fair value. Yeah, which normally includes the associated transaction cost, which normally includes the associated transaction cost of purchase, transaction cost of purchase, transaction cost of purchase. Yeah, that means if you buy a debenture or you buy a bond, so there is amount you invested. For example, let's assume you invested 1 million. Now that's what we call the cost of purchase. Then there is some transaction cost you incurred, such as to pay the broker, or that's what we call the flotation cost. Let's assume you incurred 30,000. Also, you need to capitalize this 30,000 as part of the borrowing cost. That's why we're saying that initially will be measured at fair value, including the transaction cost. Then we have to say that subsequently, they are remeasured at fair value. Subsequently, they are remeasured at fair value with the movements, stroke changes, taken to other comprehensive incomes, income, in bracket OCI, Yeah, OCI, good. Number 3, financial asset at amortized cost. Financial asset at amortized cost. Financial assets at amortized cost. In bracket, debt instrument. Right, we see that? This classification can only apply, can only apply to debt instruments, and must be designated and must be designated upon initial recognition. Full stop. For the designation to be effective, comma, the financial asset must pass two tests. The financial asset must pass two tests. As follows. Semicolon A, business test model. Business test model. You see that? To pass this test, comma, the entity must be holding the financial asset. The entity must be holding the financial asset. Only to correct contractual cash flows, associated with financial asset, Yeah, you're saying that you must only hold this asset, the contractual cash flow. In bracket, what are those contractual cash flow? Interest and dividends. Yeah, that's one of the tests. Number B. Okay, before we go to number B, let's explain another point. If this is not the case, 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 comma, such financial asset being held, and then traded, to take advantage, financial assets being held and then traded to take advantage of changes in fair value, to take advantage of changes in fair value, to take advantage of changes in fair value, comma, then the test is failed. Then the test is failed. Then the test is failed. Yeah, if you buy a financial instrument such as share, but not to earn the dividend, but you want to speculate the market price. When the market price increases, you sell them. That one does not qualify to be classified at amortized cost. Amortized cost. Also, if you have a convertible debenture, you see there is a time you have to convert it into shares. That one fails to be recognized at amortized cost. Now let's look at B. Cash flow characteristics. Test. Cash flow characteristic test. Let me see that. To pass this test, comma, the contractual cash flows corrected, to pass this test, comma, the contractual cash flows corrected must consist solely of payment of interest, and principal. Interest and principal. Yeah, for example, if you invest in a bond or a debenture, which matures in 5 years, so that means you'll be receiving the interest each year, and then upon maturity, you get back your million, 1 million. That's the car interest, and then the capital. Good. Then let me see that. Initially, financial asset at amortized cost. Initially, financial assets at amortized cost are measured at fair value. Initially, financial assets at amortized cost are measured at fair value. And then subsequently, at amortized cost, and then subsequently at amortized cost. Yeah. So that one should be at your fingertips. Yeah, that financial assets are classified into 3. Financial asset at fair value through the P&L, financial asset at fair value through OCI, and then financial asset at amortized cost. And for amortized cost, it's only comprised of those instruments which are only debt in nature. Yeah, that's why we prepare what we call our own amortization schedule. Debt amortization schedule. We don't amortize the equity. We only amortize the debt elements. Good. Subheading. Now let's look at compounding financial assets. Compounding is. Sorry? Uh-huh.
So we have considered this. Are you allowed to classify it?
No. If it fails automatically, we take it to the financial asset at fair value through OCI. For it to be at amortized cost, must pass the two tests. Sawa sawa. Hata ikipita moja yanguke hiyo ingine, still will be reclassified financial asset at fair value through the OCI. Through the OCI. Uh-huh.
Second part is the transaction costs for short-term assets.
Mm-hmm. Now, for short-term asset, that one you don't capitalize them, you expense them. Yeah. Mm-hmm. Also for the liability, you only capitalize the transaction cost only for the long-term financial asset. In case it's a liability, you expense it. In case it's for short-term assets, that one you also expense it. Yeah, it's like, for example, you see debtors qualify to be financial asset at fair value through OCI because you expect to receive the amount within one financial year. What if you incur what we call the data correction cost? So you have what we call the debt correction department. You pay them the salaries. Those are part of the cost associated with the debtors. So that one you don't go and capitalize. You say my debtors require 300,000 plus the salary I'll pay my employees. No, that expense automatically should be expensed. But in case it was for long-term assets, that rotation cost, it needs to be capitalized. They are known as the preliminary expenses. Good. So compounding financial assets. You ready to see that? Some financial instrument contains both a liability component, and equity component, Full stop. In such cases, IFRS 9 and IAS that too, IFRS 9 and IAS that too, comma, requires the component parts, the component parts of the instrument, to be classified separately, to the substance of contractual arrangement, I've said that in such cases, IFRS 9 and IS that too requires the component parts of the instrument to be classified separately according to the substance of the contractual arrangement. Full stop. Let us say that. One of the most common type of compounding is one of the most common type of compounding instrument is convertible debt. Full stop. This creates a primary financial liability. This creates a primary financial liability of the issuer, and grants an option to the holder, an option to the holder of the instrument, to convert it into equity instrument, to convert it into equity instrument. Convert it into equity instrument. Full stop. IS that too requires the component. IS that too requires the liability component. Sorry. IS that too requires the components. Sorry. IS that too requires the component to be separated as follows. IS that too requires the component to be separated as follows. To be separated as follows. Number one, calculate the fair value. Calculate the fair value of the liability component. Calculate the fair value of the liability component. In bracket, the present value of cash flows. In bracket, present value of the cash flows. Present value of the cash flows. And then number two, deduct this from the instrument. Deduct this from the instrument as a whole. Deduct this from the instrument as a whole. To leave a residual value. To leave a residual value for equity component. Deduct this from the instrument as a whole to leave a residual value for equity component. For equity component. I'm sure hamjaelewa kitu. But don't cram that. That's the provision of the standard. But it's very simple. I'll show you when we'll be doing an illustration on how to separate a compounding financial instrument into the debt instrument and the equity instrument. But it's very simple. You're saying that. First of all, you determine the debt instrument. And how do you determine the debt instrument? You determine the fair value, of which that fair value is what we call the amortized or the present value of the cash flow. Now, once you get the present value, then you take the whole component. You minus this debt instrument. Now, residual is what will be regarded as an equity. It's as simple as that. Good. Subtopic. Measurement and recognition of financial instrument. Measurement and recognition. Measurement and recognition of financial instrument. Measurement and recognition of financial instruments. Before we write, because we are writing what I had already explained, how do you measure financial instrument initially? At its fair value. And then subsequently, subsequently at fair value. Hamjamaliza. Initially, it's at fair value. What about subsequently? At fair value with changes, correct. Now that changes is very important because when you measure them again, there must be the fair value changes. Are you together? Now the question is, where do you take those fair value changes? So subsequently, we say that you measure them at fair value with the changes taken to P&L or the OCI. If it's a short term, to P&L. If it's long term, to OCI. Or the other measurement of subsequent is at amortized cost. Correct. Would I to see that? Right to see that? A financial asset or a financial liability, a financial asset or a financial liability should be recognized in the statement of financial position, should be recognized in the statement of financial position, when the reporting entity becomes a party when the reporting entity becomes a party, when the reporting entity becomes a party to the contractual provision, to the contractual provisions, to the contractual provisions of the entity, to the contractual provisions of the entity. Yes, that's when you should recognize. And this is not, it's not about measurement. It's when should you recognize a financial instrument? Only recognize when you are party to that contract, whether it's an asset to you, whether it's a liability. Now let's look at initial recognition and measurement. Initial recognition and measurement. Initial recognition and measurement. Let me see that. All financial instruments, or financial instruments, or financial instruments are initially measured at fair value. All financial instruments are initially measured at fair value with the changes in fair value, with the changes in fair value, with the changes in fair value, either through P&L, either through P&L, either through P&L or OCI, or OCI, or OCI. With the exemption, with, we are just, it's not another sentence, tunaendelea. P&L or OCI, with the exemption to receivables, with the exemption to receivables, with the exemption to receivables, with exemption to receivable, full stop. Let you see that. Receivables do not contain, receivables do not contain, receivables do not contain a significant financial component, do not contain a significant financial component, and therefore receivables are measured, and therefore receivables are measured at transaction cost, and therefore receivables are measured at transaction cost. Receivables are measured at transaction cost. Yeah, that's very correct. That's very correct. If you invest on our treasury bills for 3 months, you expect the movements, right? The value can go up, can go down, all shares. What about receivable? Receivable is part of, we say that it's a financial instrument because to one party it's an asset, to other party it's a liability. But after 2 months, you cannot tell that you are debtors. Now, due to inflation, you are supposed to pay 300. So due to inflation, I adjust that amount. Now you'll pay 350. Can that be possible? No, the data will be measured at the transaction cost. Yeah, that one is not remeasured. Yeah, you cannot use the fair value. For receivable, you strictly use the transaction cost. Now let's look at subsequent measurement. Subsequent measurement. That was initial recognition. Subsequent measurement. Subsequent measurement. Subsequent, yes? Sorry? Receivable and payable, they are the same. Because that's when we say, if to me it's a receivable, to your side it's a pay. It's a payable. But in this case, we're evaluating a financial asset, not financial liability. Yes. Subsequent measurement, we have to see that. Subsequently, comma, all the financial instruments, subsequently, all the financial instruments will be measured either at fair value, through P&L, or OCI, through P&L or OCI, or at amortized cost, or at amortized cost, or at amortized cost, or at amortized cost or at amortized cost. Now let's look at the recognition of financial instrument. The recognition of financial instrument. Yeah, to recognize. To recognize is the opposite of to recognize. Eh? Yeah, to recognize is just remove an item previously recognized in the financial statement. If you remove that item from the financial statement, that's what we call the recognition. Now, for example, if you have a motor vehicle, which is part of the non-current asset, at what circumstances will you remove that motor vehicle from the financial statement? So what are the recognition criteria for non-current assets or for an asset? When it becomes obsolete, that means the company does not expect any future benefits, correct? When you sell, if you sell the asset, you transfer the ownership. That means you don't have any contractual right to receive the benefit. One is lost or stolen. Yeah. When it's obsolete, that you don't expect any future economic benefit, but sometimes it can be compensated, right? Yeah. What else? Yeah, when the assets have been fully depreciated, yeah. But note this, sometime, for someone who was consulting just the other day, they had a machine. Actually, it was a motor vehicle, of which the company expected to be in the business for 5 years. So that means they depreciated that asset at 20% per annum. That's for 5 years. So at the end of year 5, how much will be the value? Itakuwa ngapi? 0. But that asset is in good condition now. After 5 years, the net book value is 0 because you have depreciated the asset for it. 20% per annum. We expect the economic life to be 5 years. But now you realize that at the end of that year 5, you are still using the same car. So that means the company expects some future benefits. Now, how do you consider that? Usionyeshe 0, you don't recognize because you are still using the asset. How do you measure that? Sorry? Notional depreciation. How does it work? Why does it have you mean? But in that case, we're not talking about the depreciation. We want to determine how to recognize that asset, not the expense element, but now the asset element and an non-current asset. You retain the now. Once you retain the asset, still you are retaining the asset. Are you together? That if you retain the asset, you don't recognize. That means you must recognize. Now the question is, how do you recognize that asset? Unasema ni kama uko na jibu, eh? You can try. Yeah? You do a revaluation. As simple as that. As that. Uangalie asset based on this condition. This asset, you expect it now to be usable for how many more years? Are you together? Then from there, you use the fair value model. If I'm to sell this asset now, the way it is, how much can I fetch from the market? That's what we call the hierarchy of fair value model. Eh? First of all, you look at the market value. You also look at the cash flow characteristic. Then from there, you as a management, you can agree on a value or can engage a valuer, akupe value. Then from there, you estimate it to be in the business for how many years? So in short, you just revalue the asset. Once you revalue the asset, you recognize now the revalued element, which is the fair value. Na mshike hiyo because mtakuja kuuza maswali baadaye. Not after 1 year, after 2 years or after 3 years. But next time you'll be asking me that question, I'll charge you. For now, at least I'm giving you this information for free. Yeah, the next time you'll be consulting at a fee. So now wewe vitu vingine namfunza, msikize. So we just revalue. So now let's write. Derecognition is the removal. Let me see what the honest students are saying. Fulina mmelipia kusoma, so sikiza Kenya nasema. So I'm saying now in the future, in the future, hiyo hautakuwa umelipia. Yeah, so you're saying that derecognition is the removal of a previously recognized. Derecognition is the removal of a previously recognized financial instrument. Is the removal of a previously recognized financial instrument from the entity's financial statement. From the entity's financial statement. From the entity's financial instrument. From the entity's financial instrument. Full stop. So that a financial instrument shall be derecognized. A financial instrument shall be derecognized. Shall be financial instrument shall be derecognized if semicolon. If semicolon. Number one. The asset have been transferred to the third party. The asset have been transferred to the third party, in bracket sold. In bracket sold. And in this case, we are not talking about the asset. We are talking about the financial instrument. And financial instrument are intangible asset. Or can you be able to hold shares? Say me, I have 1,000 shares. This is easy. Or a debenture. It's just a contract, right? Yeah. So in that case, I think that one of the criteria to for the recognition is when you have transferred the ownership. You had bought shares of Safaricom, then you decide to sell them to someone else. So that means those shares are no longer yours. So you derecognize them. Number two. On maturity. That is when the contractual right to receive cash flows have expired. When the contractual rights to receive cash flows have expired. Yes, as simple as that. Yeah, that means you had bought a bond for 3 years. And then after 3 years, you'll get back your money. You get back your money, automatically you recognize that as an asset because you have received your money. The agreement was to receive interest for 3 years. Now they have expired. So you don't expect to receive any future cash benefits. Good. Now let's look at impairment of financial assets. Impairment of financial assets. Impairment of financial assets. Impairment of financial assets. In our last session, we discussed about the impairment. And we say that, so you know what is an impairment? In layman's, don't define. What do you understand by impairment in layman's language? There's something I was trying to explain here. Also for financial instruments, also they get impaired. For example, if I give you a loan of 100,000 and you promise me, JM, I'll be paying you 20,000 each month. Nikilipo mshahara, I pay you 20. So that means you'll pay 100,000 for how many months? 5 months. Then for the first month, you pay me 20. The second month, you pay me 20. Then the third month, uniambie JM werewa maisha ni ngumu. I'll pay you next month. Then the second month, tell me, now JM, you know what? I got an emergency. One of my grandmother aliumwa na nyoka ushago. So nikatuma pesa. So I'll pay you next month. Now, note that the payment have accumulated for 2 months, right? 20, that's 40, right? And then he promises to pay the other third month. Sitakuwa 60. Kama ameshindwa kulipa hii 20, sasa kulipa 60 pamoja. So automatically there's that a provision. You might not recover your amount. So that's one of the indicator of impairment loss of financial instrument. Good. We need to say that. IFRS 9 effectively incorporates IFRS 9 effectively incorporates an impairment review. IFRS 9 effectively incorporates an impairment review for financial assets that are measured at fair value. IFRS 9 effectively incorporates an impairment review for financial assets that are measured at fair value. So let's look at indicators of financial impairment loss of financial asset. Indicators of impairment loss of a financial asset. Indicators of an impairment loss of a financial asset. So what are some of those indicators? Number one, significant financial difficulty. Significant financial difficulty of the issuer stroke borrower. Yeah, significant financial difficulty. Significant financial difficulty of the issuer stroke the borrower. Number two, a breach of contract, such as default, yeah, a breach of contract such as default in interest or principal payment, such as default in interest or principal payment. Number three, when it becomes probable that the borrower will enter into bankruptcy. And it becomes probable that the borrower will enter into bankruptcy. When it becomes probable that the borrower will enter into bankruptcy. Number four, disappearance of active market, for the financial asset, disappearance of active market for the financial asset because of financial difficulties, Now, those are some of the indicators of impairment loss of a financial instrument, not financial asset, not normal assets, but for financial instrument. Yeah, there is something I've been mentioning about the fair value. What do you mean by fair value? Now let's look at subheading. Fair value hierarchy. Fair value hierarchy of input measurement. Fair value hierarchy of input measurement. Fair value hierarchy of input measurement. Okay, what do you understand by fair value? Market value. Now, assume that you bought a piece of land or you want to buy a piece of land on a given price. Now, how do you determine the market value? For you to determine whether, if they are selling 1 million, whether you should pay this 1 million. How do you determine whether this land is overvalued or undervalued? How do you determine the market value? Now, that's what's provided by ISR, the fair value hierarchy. Yeah, so, right, we say that? Fair value hierarchy categorizes the input used in valuation. Fair value hierarchy categorizes the input used in valuation technique. Fair value hierarchy categorizes the input used in valuation technique into 3 levels as follows. Into 3 levels as follows. Number one, level 1 input. Level 1 input in bracket, that's the quoted prices. Level 1 input in bracket quoted prices, right? You see that? Level 1 input are the quoted prices. Level 1 input are the quoted prices, in the active market, are the quoted prices in the active market for identical assets, That's number one. You look at this piece of land you want to buy, how much the quoted price, and then the same or similar piece of land in the same area, how much is the cost? That's what we call level 1 input. Then number 2, we have level 2 input. Level 2 input. Now let me explain level 2 input. Now this was the quoted prices of that land. Then you as an individual or as a company, you need to look at other things apart from the price. For example, assume that you want to settle there. What are some of the things you will consider? You look at social amenities, right? Infrastructure, roads, water, school. Now, that's what falls now under level 2 input. Then you also have, don't write first, level 3 input. Now, level 3 input, you look unobservable items, such as, for example, how is the weather of that area? Kuna watu wanakuwa na allergy, right? Yeah, so going to an area that's too cold to be a disaster to them. Or you look at, during the rainy season, does the place flood? Now, those are the some of the factors I look at level 3 input. Now, first of all, let's look at level 2 input, Right, we see that? Level 2 input considers, level 2 input considers other factors than the quote, other than the quoted prices, included in level 1 input, other than the quoted prices included in level 1 input. Full stop. It considers observable items. It considers observable items for an asset or liability, either directly or indirectly, Number 3, level 3 input, See that? This takes into account an observable items. This takes into account an observable items for an asset or liability, Good. April 2023. Yeah, there was that question last something, no? Question 4B. Yeah, and it had 6 marks. Yeah, in light of the above statement and citing examples, briefly describe 3 hierarchical level input required by IFRS 3 fair value measurement. Yeah, so we have level 1, level 2, and level 3, and you get your answer. NB, number 1. Amortized value stroke fair value amortized value stroke fair value. Right, you see that? This is the present value. This is the present value of the future expected cash flow. This is the present value of the future expected cash flows. This is the present value of the future expected cash flows. Number 2, coupon rate. Number 2, coupon rate. This is the interest rate. This is the interest rate attached to an instrument. This is the interest rate attached to an instrument at the date of issue, at the date of issue, at the date of issue, at the date of issue. Then number 3, effective interest rate. Effective interest rate. Yeah, what do you mean by effective interest rate? Right, this means market interest rate. This means market interest rate. This means market interest rate. So we can take a small break, then we do some illustration. Handout question 1, page 2. Now, page 2, there are some revision question on financial instrument. Now, question 1, we are told that on 1st of January 2012, Mark Limited purchased a debt instrument. Mark purchased a debt instrument. So that it can either be a financial asset or financial liability. Is that an asset or liability? Mark purchased a debt instrument. Is it a financial asset or financial liability? That's a financial liability? Very wrong. Mark purchased a debt instrument. If I purchase a bond is a debt instrument, or I buy a share, to me becomes an asset or liability. To me becomes an asset, right together. If I bought that, that means I invested in that asset. So to me becomes a financial asset. So on 1st of January 2012, Mark Limited purchased a debt instrument at its fair value of 1,000, at its fair value. And that's what it said on initial recognition. You recognize at fair value. And what is fair value? You see that fair value is equivalent to the present value of the future cash flow. The debt instrument is due to mature on that 1st of December 2016. So we measure it at amortized cost. But initially, we recognize it at fair value. Interest on the debt instrument is at the rate of 4.72% coupon rate that is payable at the end of each year. We say that the coupon rate is the rate at the date of issue. Yeah, you agree that I will be receiving 4.72% per annum. The instrument has a principal amount or the par value of 1250 payable on maturity. We have been given the par value. Now, the par value will always be the maturity value, and par value is also known as the nominal value. Yeah, we have been told that. We read that statement again. That the instrument has a principal amount in bracket par value of 1250 payable on maturity. So the par value was 1250, which will be paid back on maturity. So that means this 1250 also becomes the maturity value. Now, how much will be the coupon cash flow? Now, coupon cash flow, we are given the coupon rate. The coupon interest rate is 4.72. And we have said that the coupon interest rate is the rate at the date of issue. So at the date of issue, it's 4.72 of the par value. This was the par value of the principal amount, 1250. So how much will we be receiving each year? This was a financial asset. So expect to receive interest. It was a liability you expect to pay. So how much will you be receiving at the end of each year? 59. Good. 59. Then you are told that the effective interest rate is 10%. See that effective rate is the market interest rate required. How should Mark Limited account for this debt instrument? How should we account for this debt instrument? So we account for it at amortized cost. So you need to prepare what we call the amortization schedule. And how do we amortize? So we have the years. That's 5 years. It was issued in 2012, will mature in 2016. So you have 2013, 2014, 2015, 2016. So we have the balance brought down. Then we have the interest income. These are financial assets. So an asset gives rise to an income. Now, this interest income will be based on or with the effective rate. How much was the effective rate? 10%. Yeah, based on effective rate. Then you have the coupon cash flows. Now, the coupon cash flow will be based on the coupon rate. And that one is an annuity. Yeah, you see, at the date of issue, you agree the rate of 4.72 payable at the end of each year. So that one therefore becomes an annuity. That's what you call the cash flow. So an amount of 59, 59, 59, 59, 59, and then we get the balance carried down. Let's read the question again. Remember, you said that financial instrument initially will be recognized at fair value. Let's read the question again. On 1st of January 2010, Mark Limited purchased a debt instrument at its fair value of 1,000. So the fair value initially to be recognized at fair value, which is 1,000. The debt instrument is due to mature on that 1st, 2016. Interest on debt instrument is at the rate of 4.72% coupon rate that is payable at the end of each year. So that one, it becomes an annuity, will be constant at the end of each year. The instrument has a principal amount of 1,250 payable on maturity. Remember, it will mature at the end of 2016, and it will mature at its par value, which will mature on maturity. So on maturity, you get back your 1,250. Required. How should Mark Limited account for this debt instrument? Now, this is how you amortize. The fair value of the initial recognition is 1,000. You determine the interest based on the market rate. 10% of 1,000 you get 100. Now, this is what you earned, but this is what you will receive, because this is what you are getting to be receiving each year. So this is what you determine the balance carried down. You take 1,000, you add the interest earned of 100, so you get 1,100. But by the end of the year, you have already received 59. How much will be the balance? You get 1041. The balance carried down becomes the opening balance. So you have 1041. 10% of this, you get approximately 104. So you take 1041, you add the interest and then you deduct what you have already received by the end of the year. How much will be the balance? Sorry? 1086. The balance carried down becomes the opening balance. We have 1086. 10% of this. Let's work with 109. So you take 1086, you add the interest and you deduct what you have already received. 1136. The balance carried down becomes the opening balance. 1136, 10% of this. Let's now, this one we round up. This one you have rounded down. So it's still okay. 1136, you add 113, you minus 59. 1190. So the balance carried down becomes the opening balance. 1190. 10% of this you get 19. You take the balance brought down, you add the interest and you deduct the interest received. Do you get 1250? Yes, that's how you amortize the debt. Now the question is, how will you be accounting for this? Now, what you take to the income statement is this. This is what you now will go to the P&L as part of other income, interest income. Yeah, you recognize. Remember, you prepare the financial statement on accrual basis. What you earned, not what you received. This is not what you recognize. This is what you received. This is what you earned. So what you earned is what you take to the P&L. Then the balance carried down, you take it to the balance sheet. It's for 5 years. Therefore, it's a long-term financial assets. So you recognize it as a part of non-current asset as available for sale financial instrument. As simple as that. Or, now listen here. In this case, you are given the principal amount and you are given the fair value. What if you are not given the fair value? How do you amortize the debt? If you're not given the fair value, how do you amortize the debt? So to amortize the debt, initially you recognize it at fair value. And we said, what is fair value? Now, fair value, can you go back to your NBs? Amortized value of fair value. You see that is the present value of the future cash flows, which will be to get the future, the fair value, you take the present value of annuity, of which the annuity in this case is the interest, plus the present value of maturity value. And then you expect to receive back your 1250. So present value of an annuity, we have the interest. Now, this interest that we'll be receiving, 59, 59, 59, that's what we call an annuity. So you'll take 59 times present value interest factor of an annuity, then you discount using the market rate. How much was the market rate? 10%. 10% for 5 years plus present value of maturity value. So at the end, you expect to get back your money, and you have invested 1250 times present value interest factor 10% at the end of year 5. So it's 59. 10% for 5 years, you get 3.08. 1250, 10% at the end of year 5, you get 0.6209. Good. How much is that? Yeah. So get a figure which is equal to 1,000, right? Yeah. In case you're not given the fair value, that's how you determine. It's all about determining the present value of the future cash flows. Let's do question number 2 of the handout. Question number 2. That was question number 1. Question number 3, I told that Summit Limited issued a bond. Summit issued a bond. Is it a financial asset or financial liability? Summit issued. Asset or liability? Yeah, that's a liability, correct. Yeah, Summit Limited issued a bond for 543,778 on 1st of January 2014. No interest is payable on the bond. So in that case, there is no this element of cash flow. No interest is payable on the bond, but it will be held to maturity and redeemed on that 1st of December 2016 at 600,008. So that means it will mature at a premium. But in this case, they will not be paying the interest. You held it to maturity. Required. Calculate the finance charge. Now that's the interest expense and the carrying amount of the bond until maturity. How do you amortize that? So we prepare the amortization schedule. Can you read that question again? Yeah. So we are told that in this case, no interest payable. So in this case, there is no column for cash flow, but it will be held to maturity. So just take the opening balance, you determine the interest charge for the year, and then you accumulate until maturity. Now, Summit Limited issued a bond for 543 on 1st of January 2014. So as at 2014, the fair value on issue recognition was 543,778. No interest is payable on the bond, but it will be held to maturity and redeemed on that 1st of December 2016 at 6. Yeah, December, that's the balance carried down. It will mature at 600,008. Now the question is, determine the finance charge and the carrying amount of the bond. Now, finance charge is the interest expense. Remember, this is a financial liability. So how do you determine this? Now, number one, you're not given the interest rate. How do you determine the effective rate? If you're not given, this is how you compute. You know how to discount. How do you get the present value? present value, take the future value, 1 plus r raised power negative n. How do you get the future value? You take the present value, 1 plus r raised power n. Do we have the future value? How much is the future value? Yeah, 600,008 at the end of year 3 is equals to, do we have the present value? Yes, the present value of the fair value, it's 503,778, 1 plus r. Now what we need is this r, the rate. And for how many years? 3 years. Good. From there, what do? You divide by 503,778, 503,778. That one and that one will cancel. So 1 plus r cubed will be equal to 1.19. We want r. So what do? Even in any. You get what? You get the cube root, right? You get the cube root on both sides so that you can eliminate this. So this one will be 1 plus r. Give me the cube root of 1.19. You get 1.0, 1.06. Now, can we be able to get r? Now, this will get the cube root. When you have a cube root, you press 3, shift, raised to power, then 1.19 equals, you get 1.06. So to get r, you take 1 to the other side. So 1.06 minus 1, you get 0.06, which is equivalent to 6%. Yeah, 6%. So that means the interest expense will be 6%. So it will be 543,778. 6% of that is how much? 227. So you take the balance brought down, then you add the interest expense charge for the year. Now, how much will be the balance carried down? You accumulate, you get 530, 534,005. Now the balance carried down becomes the opening balance. So I have 534,005. 6% of that is how much? That's 040. You take the balance brought down plus the interest expense. Now you'll get 5,045. The balance carried down becomes the opening balance, and you have 566,045. 6% of that is how much? 963. You take the balance brought down plus the interest accrued for the year. Do you get 6,008? Good. That's how you're supposed to account. Now, for the interest expense, now this is what they take it to the P&L. 2014, this will be the interest expense. 2015, this is the amount. 2016, this is the amount. And then this is now what you take it to the balance sheet as part of non-current liability. It was a liability. So you can copy. So let's try another illustration. May 2018, question 4A. E Limited issued a bond. Is it a financial asset or liability? Yeah, that's a financial liability, correct. E Limited issued a bond for 200 million on 1st of January 2018. 2018, they issued a bond for 200 million. Interest on bond is payable in arrears on that 1st December each year at the rate of 12% per annum. At the rate of 12% per annum. That 12% per annum is what we call the coupon rate. So it's 12%. So that's what we call the coupon payment. It's 12%. The debenture had a value of 200. That means they'll be paying how much? Is that 24? They'll be paying 24, 24, 24 at the end of each year. The bond will be held to maturity and redeemed on that 1st December 2020 for 258.24. The bond will be held to maturity and redeemed on that 1st December 2020. It was issued on 1st of January 2018. So we have 2019 will mature in 2020 at 258. So the balance carried down 2020, it will be 258.24. The effective rate of interest is 20%. So the effective rate will give us the interest expense, of which we are told is 20% per annum. Good. The bond has not been designated as its fair value through profit or loss. That's the the fair value through the profit and loss. Required. Charge to the income statement. Now, before I go to the charge, now let's amortize. Let's amortize. So the cash flow does not change. And you see that the coupon payment will be 24. And that one becomes an annuity. They'll be paying 24, 24, 24 each year. But the interest expense rate to the income statement will be based now on the effective rate, which is 20%. So you'll take 20% of 200, you get 40. So it's 200. Then you add the interest accrued for the year, but they agreed that they'll be paying 24 each year. So you minus 24, what they have already paid. So how much will be the balance? 216. The balance carried down becomes the opening balance. 216, 20% of this is 43.2, right? You take 216, 43.2 minus 24. Sorry? 235.2. The balance carried down becomes the opening balance. 235.2, 20% of that? 0.4. You take the balance brought down plus the interest expense, then you deduct what they have already paid. Does it add up to 258? Good. That's how you amortize. Now the question was required. I'll go to the required. Charge to the income statement for each of the 2 years, ending that 1st December 2018 and 2019. Number 2, extract from the statement of financial position. Yeah, what do you take to the income statement? What do you take to the balance sheet? Eh? So you said that the interest expense is what you take it to the P&L. Then the balance carried down is what you take it to the balance sheet. How do you show that? So income statement extract. Now, this was a financial liability. A liability gives rise to expenses. So you have interest charges or interest cost, 2018, 40, 43.2, 47.04. And then to the balance sheet, that is the statement of financial position. Extract 2018, 2019, 2020. So these are financial liability. So to the non-current liability, we have 12% bond. So 2018, 216, 235.2, and then we have 258.2. As simple as that. That's how you're supposed to account for that debt instrument. Now, before we copy, let's do an illustration. In case of a compounding interest, I mean compounding financial instrument. Yeah, May 2021. May 2021, question 4B. Naivasha Limited issued 500 convertible loan notes. Financial asset, financial liability? That's liability, yeah. Naivasha Limited issued 500 convertible loan notes. In case it's a convertible loan note, that's what we call a compounding financial instrument. Being a convertible, it will have a debt instrument, debt element, as well as the equity element. Yeah, Naivasha Limited issued 500 convertible loan notes on 1st of January 2018 at par. So that means they are issued at par value. Each loan note is redeemable in 3 years' time at its par value of 2,000 per note. redeemable at its par value. So that means the maturity value, they'll mature at its par value. How much is the par value? 2,000. And they had issued how many bonds? Yeah, they had issued 500 convertible loan note on 1st of January 2018 at par. And they are told that the par value is 2,000. So that means they issued a loan note worth how much? Is that 1 million? Yeah. They issued a loan note worth 1 million. So how do you account for this? We read that again. Naivasha Limited issued 500 convertible loan note on 1st of January 2018 at par. Each loan note is redeemable in 3 years' time at its par value of 2,000 per note. Alternatively, each note can be converted at the maturity date, that's on 1st of January 2021, into 125 10 shillings ordinary shares. Second paragraph. The loan note pays interest annually in arrears at a coupon interest rate based on the nominal value. What is nominal value? Par value, correct. The loan note pays interest annually in arrears at a coupon interest rate based on the nominal value of 6%. So the coupon payment, it's 6% based on the par value. Now, this was the par value. So they issued 500, each at 200. So the total was 1 million. So that means they'll be paying an interest of how much? That is 60,000 each year. 60, 60, 60 for 3 years. The prevailing market interest rate for 3-year loan note without conversion rate is 9%. Now that's the effective rate. Required. Prepare extract. So before you prepare the extract, you have to amortize. Now this is a coupon. This is a compounding financial instrument. It has a conversion terms. So how do we get, first of all, the debt? Now to get the debt, you have to amortize the debt. And how do you get to amortize the debt? So how do we determine the fair value of the debt element? And we say that the fair value will be equivalent to the present value of future cash flows. And how do we get that? So to get the fair value, how do we get the present value of the future cash flow? You'll take the present value of an annuity, of which the annuity will be the interest, 60 for the next 3 years. So that's the interest, plus the present value of maturity value. And we are told that it will mature at its par value, which is 1 million. So therefore it will be the present value of an annuity, the interest per annum will be 60. You discount present value interest factor of an annuity. How much is the effective rate? 9% for 3 years. Present value of the maturity value, it will mature at its par value. That is 1 million times present value interest factor, 9% 3 years. So this one will be 60,000. 9% for 3 years using the annuity table. Use the formula 1 minus 1 plus r raised to power negative n over r. Yeah, this is AFR. You'll not be given the discounting table. Hata hapo hakuna table. Use this formula for annuity. 1 minus 1 plus r raised to power negative r over r. These are single cash flow. For single cash flow, it's 1 plus r raised to power negative n. Good. At 9%, what are you getting? $2.2782. 1 million. 9% for 3 years. You just take 1.09 raised power negative 3 equals, you give me the answer. 2.4, eh? 2.2, good. So now give me that. Now that's how we get the debt instrument. This is 2.53, 1.13, eh? But this one is okay. Eh? Hey, simunipe answer. 924.0. Yeah, 0.70. Now that's the debt element. Eh? What about the equity element? There is something I told you trade. Okay, can you go back where he had the compounding? Eh? There's something you indicated. Eh? How to determine or how to separate the debt and the equity component. Number one was what? Number one is calculate the fair value of the liability of which we have. Then to get the equity elements. Number two was what? Deduct this from the instrument as a whole to leave a what? Yeah, to leave a residual value. Now, the whole amount was 1 million. So you take this 1 million, you deduct the fair value of the debt, 924,078. Now, the residual is what will be regarded as an equity instrument, which is 75,920. Yeah, 922. So how do you account for it? We amortize. And we don't amortize equity, we only amortize the debt. So amortization schedule. So here we have the period. It was issued, the debt was issued on 1st of (2018). It was for 3 years, 2018, 2019, 2020. And then we have the balance brought down. Then we have the interest expense. Then we have the coupon cash flows. And then we get the balance carried down. Now, the coupon cash flow, that one does not change. It's the annuity. The coupon cash flow, it's 60, 60, 60. 2020 at the end, it will mature. How much was the maturity value? Kila kitu iko pale. Maturity value was how much? 1 million. Good. Now the question is, how much is the fair value on initial recognition? Ni ngapi? Haiko kwa karatasi, iko papa mbele. Yes, yes. Actually, I told you, if you want to understand me well, listen what I say, not what you write. Sawa. There is something I mentioned here. We amortize. And nimesema, what do we amortize? We amortize the debt, and we have the fair value of the debt. That's what we amortize. The fair value. This is what you computed for the debt element. This is what we are amortizing, which is 924,078. Then the interest expense will be based on the effective rate, which was 9%. Good. So you take 9% of 924,078. $83, 167. So you take the balance brought down, you add the interest accrued for the year, then you deduct what they had already paid. You get 940, 947, 245. The balance carried down becomes the opening balance. So you have 947, 245. 9% of that, 85, 252. You take the balance brought down, you add the interest, you minus 60. 972, 497. The balance carried down becomes the opening balance. 972, 497. 9% of that is how much? 525. You take this plus this, minus 60. Do you get a figure approximate 1 million? Yes. Now the question is, what do you take to the income statement? What do you take to the balance sheet? To the income statement, we have the expenses, where we have the interest expense, 2018, 2019, 2020. So the interest expense, you take 83,167, 85,252, 87,525. What about the balance sheet? So statement of financial position extract. So this one was a liability. So you have equity and liability. And we have the equity component. Now, the equity component does not change. It will remain to be 75, 922, 75, 922, 75, 922. Then under the non-current liability, we had 6% loan note. Yeah, so now you take the balance carried down. So we have an amount of 947, 245, 972, 497, and here you'll have 1 million. Good. Can copy? So, and that marks the end of financial instruments.